talk a little bit about investing into mutual funds via the SIP route or the lump sum, because this is an often asked question to us as advisors, that should I invest through a systematic investment plan route, which probably means investing small portions over a long period of time, or should I invest a lump sum, or commonly called a one-time investment into a mutual fund. So there are several pros and cons of each of these, and there are factors which they depend upon. So in this video, let's probably discuss a couple of factors that you should consider before making this investment. I'm going to start off with the fact that an SIP investment is a regular form of investing. So which probably means if I have $1,20,000 to invest, I set up an SIP of $10,000 every month for the next 12 months to invest that amount. An alternative to which would be probably just investing that entire $1,20,000 at one point in time. When the market is growing continuously, or we see that we're probably in a phase where there is little or no scope for any major market corrections, it would be recommended for you to actually invest via the lump sum route. If we're looking at a market which is probably slightly volatile, maybe going downward, it is the best option to go through the SIP route, because you're making averaging investing your money. So instead of putting the entire $1,20,000 on one particular day, you're making use of that volatility and investing small portions to make a value cost investment. There are other factors that investing via SIP or lump sum or one time depends upon. Very importantly, your risk appetite. For instance, a lump sum or a one-time investment is highly suitable for very high risk takers who probably think that the timing of that investment does not matter as much to them. But for people with slightly lower or moderate risk appetite, it would make sense for you to go via the SIP route, so that you are, like I spoke earlier, averaging your investment and getting into it. Also, in the scenario that you do have the clarity that you need that money 3 or 5 years from then, I would definitely recommend that you go through the SIP route than the lump sum route, because what could happen is that, and I've seen these situations in the past where people have invested lump sum amounts and 3 years later or 1.5 or 2 years later, they're probably still at the same place in terms of the investment, and the investment has not grown as much, because when they invested, they probably invested at 34,000 levels, and 2 years later, the market has seen certain corrections, and on the day they want to withdraw their money, it is at that 34,000 level again. So it does not make sense for people to invest into lump sums when they know that they definitely need that amount in a certain period of time. Another important part is the cost of investment. So like I've been talking to you, when you're investing through the SIP route, the cost of investing is low. But in the case of a lump sum investment, it is high, because logically at that point in time, you may not be timing the market. We are not all experts to time the market as well. I'm not a big fan of timing the market too. But yeah, so if you do choose to make a lump sum or a one-time investment, the cost of that investment could definitely be higher.
Hey incredible investors, if you learned something new today, please like this video. If you would like to share what you've learned with your friends, family or others who could benefit from this learning, please share our video. And if you would like to stay in touch with more personal finance topics on how to manage your money better, please subscribe to our channel. Until then, happy investing. Thank you.